Let's dive into some specific candlestick patterns starting with hammer. The hammer is a bullish reversal pattern that looks like, a hammer. It has a small real body and a lower long shadow. A hammer candlestick has little or no upper shadow, and its lower shadow is at least twice the length of the real body. This pattern often appears after the downtrend and signals a bullish reversal. Here is the psychology behind this hammer. The session starts with seller pushing the price lower, but then buyers step in, driving the price back up. The price closes higher than the opening, forming the distinctive bullish pattern. Traders often use this pattern as a signal to enter long position. If a bullish candlestick forms the next day, it confirms the reversal. Traders can set their entry point slightly above the high of the hammer and place a stop loss at its low. In this chart, you can spot a hammer pattern. Following the hammer, a bullish reversal occurs. The stock's prices rises significantly. The entry point would be here, just above the hammer, and stop loss would be here at the low of the hammer. Next one is hanging man. The hanging man is a bearish reversal pattern that looks like this. Once again, it has a small real body and a long lower shadow, and its lower shadow is at least twice the length of the real body. A hanging man candlestick has little or no upper shadow. This pattern often appears after the uptrend and signals a bearish reversal. Here is the psychology behind this. The session starts with seller pushing the price down, then buyers came into the market and pushed the price up, but unsuccessful in doing so as the price closed below the opening price, forming a bearish candlestick pattern. This shift indicates the seller are regaining control and the uptrend may be nearing to its end. Traders can enter a short position if the next bearish pattern is formed. Traders can set their entry point slightly below the hanging man and place a stop loss at its high. Let's understand with an example. In this chart, you can spot an hanging man pattern. Following the hanging man, a bearish reversal occurs and the stock price goes down significantly. So the entry point would be here and the stop loss would be here at the high of the hanging man. Next one is the gravestone doji. The gravestone doji is inverse of dragonfly doji. It's a bearish reversal pattern that looks like this. It has a very small real body and a very long upper shadow. A gravestone doji candlestick has little or no lower shadow, and its upper shadow is very long as compared to the length of the body. It has a flat and very thin real body. This pattern often appears after an uptrend and signals a bearish reversal. Psychology behind this candle. It is formed when the buyers initially push the price higher, but sellers eventually take control and drive the price down, and the uptrend may be in its nearing point. Traders can set their entry point slightly below the lowest point of the gravestone doji and place the stop loss at its high. Let's understand with an example. So in this chart, you can spot an gravestone pattern. Following gravestone doji, a bearish reversal occurs and the stock price goes down significantly. So now guess what is the entry point and stop loss among A, B, C. Do comment your answer in the comment section. And that's your introduction to candlestick. Remember, learning to read these patterns takes picture, and it's one of the most powerful tools in a trading arsenal. If you enjoyed this breakdown and want to learn more about specific pattern, leave a comment below and let's know. Don't forget to like and subscribe and hit the notification bell so that you never miss a video. Thanks for watching, and I will see in the next video.